When the Nifty hit 20,500, the small cap, the mid cap index also gave it company. So you had a peculiar situation where across the breadth of the market, indices were at new highs. At that point, everyone was showing their fingers up when it came to the direction of the market. But in a few months, things have turned, and how? We saw the Nifty very close to 19,000. The small cap and mid cap indices have turned direction. We would know whether it is a decisive direction in the coming weeks. But overall, with every passing week, we get the feeling that the markets may well be heading into a correction. A few weeks ago, nobody was ready for it, but a few weeks down the road, everybody would need to prepare for it. So in this video, we are going to talk about how to prepare for it, and let's hear what Subra has to say on how he is preparing for a market correction and how others can prepare themselves adequately. Over to you, Subra.
When the market is high, it's a great time to be starting to prepare for a market fall. Very rarely do people do it, right? People feel, now this is permanent. The market is at a new high. It will always be there. This is a new thing. It has never happened before, but this is going to happen now. So this is what is going to happen. This is the new normal. And market, I keep calling market the great humiliator, as Ken Fisher says. Exactly when you think there is no risk like this, it turns around and slaps you so hard that you realize that 40 years experience, 44 years experience or 4 years experience means nothing, because you thought this risk is not there and then that risk happens. Is it likely to happen now in October, November 2023 or November 2024? We don't know, but we know it will happen. How does one prepare for it, right? That's the question. So first of all, check your asset allocation. If you are 80% into equity or 90% into equity because that was the best performing asset class, it's a fantastic time to relook at your asset allocation. Make sure when you look at your asset allocation, you are say 70% in equity or something like that, maybe you are more comfortable. If thought of a recession or a market fall is going to give you sleepless nights, very clearly your asset allocation is wrong. Relook at your asset allocation. Even among the equities that you hold, if you are say 70% in small cap and 30% in mid cap, because you thought large cap is no use, it's not giving any return, relook at your asset allocation also. Maybe you should reduce your small cap and mid cap and add some large cap to it. If you don't want to do all that, take some money out from equity and put it into multi-assets or BAF, which is the Balance Advantage Fund, because there the fund manager will do it more scientifically than you will, because you somehow don't want to give up that horse which is winning, right? So even at 11:58 you're hoping that you'll do something, even though you know that the clock could strike at 12 and all your horses could become pumpkins. So you don't want to give up that winning horse, so you stick to it. So don't do that. Check out how well are you placed for the next 3-4 years of the market doing badly. Do you have adequate reserves? Is your job good? Is your wife's job good? Are your children's fees being paid off? Because normally what happens is, when you're doing risk profiling with your relationship manager or you're sitting by yourself and doing it, you tend to say, oh, I can take a 30% fall. But please understand, when the market falls 30%, your wife is pregnant and she's been advised bed rest, and your boss calls you and says, look, I'm giving you 4 months notice, but you may have to find a job. Your risk profile changes dramatically. So just check out how good is your job.
You're giving a family doomsday here.
No, I'm saying these things can happen. It has happened. It's not that it never happens. I mean, there are women who give up their job and they're unable to go back to the job.
You can add one more variable, that the election result in 2024 will be an upset and India today carries a poll or something like that.
Absolutely. Any of these things happen, and unfortunately or fortunately, all these things happen at the same time when you're least expecting it. LTCM is a fantastic example of 2-3 things going wrong, then it is A into B into C, and it does happen. We have seen this over so many years. So be prepared for such events. Maybe the probability is maybe 1% probability for you to lose your job and 1% that your wife will lose her job, but 1 into 1 can become a problem.
So you are saying that when everything is so pink and rosy, start being counterintuitive.
Start being counterintuitive. Start asking yourself, what happens if this goes wrong? What happens if this goes wrong? Right? Those things happen in real life. I have seen a 52-year-old man who had to give up his job to look after his father.
That is normal.
This is normal. So a you always think that 50 to 60 I'm going to max out my income. This 52-year-old man had to give up his job to look after his father because his wife could not. If that time, 2-3 years of your time is lost, at 55 you can't get back into the job market. Be ready. I'm praying to God that nothing like this happens, but all these things happen at the same time.
So your preparation agenda is, don't run the highest risk strategy around this time. Reduce your risk. That's your first point. The second point is, move money from equity as an asset class and within equity from the highest risk zone to a moderate risk zone, or out of the asset class into gold, into maybe a multi-asset mutual fund or debt or liquid funds or whatever.
Right.
And you are saying that keep that powder dry.
Correct.
What if nothing happens for 2 years? See, what if, contrary to what the media is thinking, the 5 state polls don't throw up big surprise, and from January, the pre-election surveys start giving us comfort that there is going to be continuity of regime. What if all this happens? Then the investors who are buying these dips constantly may turn out to be the smarter ones in the near term. No, that is possible.
See, one very important thing I always say about equity investing is, you have to be willing to look foolish in the short run to look smart in the long run. Sit with your family, sit with your wife, sit with your children and tell them this is the risk that you are running, because your wife could be far more sensible than you are and say, look, we have enough, right? We have this, so why are you taking more risk? Is there a need to take risk? Because the need to take risk, ability to take risk, everything has to be, a congruence at the time when you're taking the risk. Sometimes you don't need to take risk. You're 55 years of age, your children are settled, all the goals are met. Then start taking risk at 65 because your children are also reasonably doing well in life. That's a fantastic signal for you to say, okay, if something goes wrong, my children are rich enough, so they don't need my money. In the worst case scenario, I have some money lying in there. So your risk profile changes. So check your risk profile, sit with your family, see whether this risk is needed. If it is not needed, don't take risk. Don't take risk just for the fun of taking risk.
Also, when you are doing so well, like in 2020, if you ask somebody to predict where their portfolio would be in 2023, not even one person would have predicted that they would be here. There is zero confidence actually. But when the portfolio is where it is today, we don't see humility, we see overconfidence. So basically, it's probably a time when directionally this confidence must reduce a little bit. It's actually good to be a little less confident now than be overconfident as most people are.